So here's a number that should stop you. Crypto is a $2.66 trillion asset class today, and almost everyone argues about it using the wrong map. They watch candles, they watch headlines, but the thing actually moving all of it is sitting on a Federal Reserve spreadsheet, about $5.9 trillion of what's called net liquidity. So we're going to do something simple but rare. Put crypto's own on-chain numbers right next to the traditional macro data and read them together, honestly, live, with every source on screen. No price predictions, just what the data says, and some of it's going to surprise you. Okay, let's ground this. If you're new here, I don't want to lose you. And if you do this for a living, stay with me. The payoff's in a second. Picture two worlds. On one side, the on-chain world. Crypto's own data, pulled straight off the blockchains. Total market cap, 2.66 trillion. Stablecoins, the dollar-pegged tokens, about 320 billion. Money locked inside DeFi apps, around 82 billion. These tell you what's actually happening on-chain, who's transacting, what's held, where the money sits. That's CoinGecko and DeFiLlama, both up on screen. On the other side, the macro world, the part crypto people skip, the plumbing underneath everything. The Fed's balance sheet, 6.7 trillion, real interest rates. The VIX, which is the stock market's fear gauge, the money supply, the dollar. That's the Fed's own database, Fred. Now here's the key idea on this page, that 2.66 trillion in crypto is essentially riding on about 5.9 trillion of Fed liquidity. And why would crypto, of all things, ride on that? Because it's the riskiest, most speculative asset in the room. When the system is flush with cash, investors push money out into things like crypto last. And when cash gets scarce, they yank it out of crypto first. It sits at the very end of the risk curve. So macro data doesn't tell you what crypto is doing. It tells you the weather crypto is doing it in. On-chain is the activity, macro is the weather. And the whole game, the thing the pros get paid for, is the bridge in the middle, laying the two on top of each other and asking, why is capital really moving? Read either one alone, you get fooled. Read them together. That's where it gets interesting. So let's walk the bridge. So start with liquidity, the tide everything floats on. There's a measure desks watch every week called net Fed liquidity. The Fed's balance sheet, minus the Treasury's checking account, minus reverse repos. Just think of it as how much cash is sloshing around the system. Index it against Bitcoin. Set both to 100 at the start and watch the shape. And they move together. Tied in, crypto floats up. Tied out, in 22, crypto sinks with it. So far, the story everyone tells. But here's the part nobody's pricing in. There used to be a giant cash cushion parked at the Fed, the reverse repo facility. It peaked at $2.55 trillion at the end of 2022. As of right now, it's under 1 billion. Empty, 100% drained. And why did it drain? Simple. The Treasury flooded the market with new short-term bills paying a juicy yield, so all that parked cash got pulled out to go buy them. The cushion emptied straight into the bond market. Why care? Because that's the shock absorber that softened the last drawdown, and it's gone. From here, liquidity swings hit more directly. Now look closely. Bitcoin's actually sitting below where that liquidity alone would put it. And that's the honest catch. Liquidity is necessary, but it's not sufficient. Something else is holding crypto down, which is the second chart. You've heard Bitcoin called digital gold, the idea it hedges inflation. When real interest rates, the rate after you strip out inflation, rise. So does it? Run one straight line through 5 years of data, and it looks like a hedge. The number's positive, plus 1.14. But that's a trap, a spurious correlation. Both real yields and Bitcoin drifted up over 5 years for unrelated reasons, and one line can't tell them apart. Measure it the right way, rolling 1 year at a time, and it flips negative, minus 0.09 right now. And why does negative mean risk asset? Because when real yields rise, safe bonds suddenly pay you to do nothing. So money rotates out of risky, no-yield bets like crypto and into bonds. A real hedge wouldn't flinch. A risk asset bleeds. And that's exactly what happened. While gold hit record highs this year, Bitcoin fell, right alongside tech stocks. So today, Bitcoin isn't trading like digital gold. It's the riskiest thing in your portfolio. And that's fine. You just have to be honest about which one it is. Okay, if it's a risk asset, how much does it move with your other risk assets? This is the most important chart for anyone treating crypto as diversification. I'm plotting the rolling 90-day correlation between Bitcoin and the Nasdaq. Correlation just means, do they move together? +1 is lockstep. 0 is no relationship. Right now, we're at 0.45, the upper third of its 5-year range. So when people say crypto is uncorrelated, that's just not what the live data says today. And why is it glued to tech now? Because the same big funds buy both, especially through the new spot ETFs. So when they de-risk, they sell crypto and the Nasdaq together. Worse, those red and green bands show the correlation doesn't sit still. In a real panic, it spikes toward 1. So crypto gives you the least diversification at the exact moment you need it most. That's not negativity. It's just how it's behaved. But here's the hopeful flip side. Volatility, just a fancy word for how wildly the price swings. Bitcoin's reputation is it's insane. 30–40% moves. Well, its realized volatility right now is about 26%, against a historical average of 73, a third of its own normal wildness. And next to the VIX, the stock market's fear gauge, Bitcoin is now only about 1.6 times as volatile as the S&P 500, and that number usually averages around 4.5. So why is it calming down? More institutions holding it, ETFs absorbing the swings, deeper markets to hedge in. That's maturation. It's slowly behaving like a normal asset, a genuinely positive story, just a quieter one than the headlines like. Now one layer deeper, into something only on-chain data can tell you. The stock market has no equivalent. A metric called MVRV. Don't let the acronym scare you. It's just today's price divided by the average price every coin last actually moved at. Think of it as, are holders on average in profit or at a loss? Above 1, they're up. Below 1, they're underwater. Put Bitcoin and Ethereum side by side, and you get a fascinating split. Bitcoin's MVRV is about 1.42. The typical holder is comfortably in profit, but nowhere near euphoria. Historically, tops came in above 3, so this is mid-cycle, not frothy. Ethereum's, though, is right around 0.96, just under 1. The average Ether holder right now is underwater. And why the split? Because Ethereum's buyers, on average, paid more than it's worth today. Its price never climbed back above their cost, while Bitcoin's did. Same market, same week, two of the biggest assets in the space, completely opposite holder economics. And I cross-checked it. Coinmetrics and Glassnode both land in the same place, both on screen. One more honest detail. Over the last month, the amount of both coins sitting on exchanges actually ticked up, Ethereum's by almost 5%. Coins moving onto exchanges usually means people positioning to sell, not hold, so that underwater Ether picture lines up. None of this is a price call. It's just the on-chain reality, telling you these two are in very different places. Last stop. And this one ties crypto and traditional finance physically together. Stablecoins. Crypto tokens pegged 1-to-1 to the dollar, and under the new rules, backed mostly by short-term US Treasuries. The bars here are total stablecoin supply. The line is USM2, the standard measure of the money supply. Stablecoins just crossed $320 billion, up 34% in a single year, now about 1.4% the size of M2. And why does that matter for crypto? Because stablecoins are the dry powder, the on-chain cash sitting ready to buy. More of them means more buying power waiting in the system. And after the Genius Act, every one of those dollars is backed by and funnels demand into US Treasuries. So crypto is quietly becoming a real buyer of government debt. Then the punchline, the chart that surprised me most. For years, the whole DeFi pitch was earn way more than a boring bank. And it was true. Lending stablecoins on Aave used to pay double digits. So I plotted that DeFi yield against the risk-free rate, the 3-month Treasury bill. Right now, DeFi pays about 3.4%. The T-bill pays 3.7. The spread is minus 0.26. The premium has gone negative. And why did it flip? Because T-bill yields climbed with the Fed's rate hikes, while demand to borrow inside DeFi cooled off. So on-chain lending rates fell below the risk-free rate. Translation: you're no longer being paid for the extra smart contract risk. So capital is rationally rotating into tokenized treasuries right on chain. So let's bring it home. Is crypto a bet on the Fed? Today, the data says largely yes. It floats on liquidity now running without its old cushion. It trades like a risk asset. It moves with the Nasdaq, and even its own yields bow to the Treasury market. But it's also maturing, volatility compressing, building a real dollar economy on chain. Here's the honest part. I can't tell you what happens next, and anyone who says they can is selling something. But I can tell you exactly what to watch, all public, on the same dashboards I used: net liquidity, the Bitcoin-Nasdaq correlation, stablecoin supply, and that DeFi minus Treasury spread. Those 4 lines will settle this long before the headlines do. So that's the bridge. Crypto isn't an island. It's a high beta passenger on the macro tide. And right now, that tide is running without its safety cushion. But it's also quietly growing up, calmer, more correlated, building its own dollar plumbing in plain sight. The point was never to tell you what to think. It was to hand you the map and the sources so you can read it yourself. Every number in this video is recorded on the Notion page, with each source linked: Fred, Coinmetrics, DeFiLlama, Glassnode, CoinGecko, all dated, all shown on screen. Go pull them yourself. Verify me. That's the whole idea. If this way of looking at crypto, macro and on-chain together, honestly, is useful to you, subscribe and stick around, because this is exactly what we do here. Drop a comment with the one chart you'd want to see next. The full write-up, with every source linked, is in the description. Thanks for watching. I'll see you in the next one.